This is Cece. Welcome to the Orbit. It is Monday, March 4th. We've got stocks down slightly in the red, basically unchanged. But it is a slight pullback from what we saw on Friday, which was a really, really strong grind higher. And you can see that on this 1 week chart. Look at those green candles, and that is basically Friday. Barely any down ticks the entire day, and the market just powered higher and never really looked back. We are looking back slightly today, but not much. It's not much of a pullback. The expected move for today is about 0.25% right now. That is down from about 0.4% coming into the open. We are about half an hour into the trading day. We are at very low volatility. And because this is income from options weekly, I want to talk about that low volatility and that slow grind higher. If you look at Friday's action, where you saw basically a 1% move higher, which was a lot more than what options were pricing, or almost 1% move higher. What ends up happening in a lot of scenarios is the people that are selling options, and whether that's covered calls or iron condors or credit call spreads, tends to be in those kinds of conditions, in low volatility, bullish market conditions. Those tend to be the times when you get taken out on those credit spreads to the upside. And the reason is because the volatility is so low as the market goes higher. So a 1% move higher, even if it happened 2 to 3 times that week, is not enough to actually make the VIX go higher. It is, even though that's twice as much as the expected move that day, the VIX might be down on a day like that. As opposed to if the market was down 1%, you'd probably see a pretty significant pop in the VIX, and you'd be able to sell options at a little bit more premium. So these are the conditions where you kind of have to be careful, where you actually might see some moves, some powerful moves like we did Friday, and it's to the upside. So it's almost like the risk is, until there's actually any significant move lower, where you actually saw a vol pop, the risk when you're selling credit spreads and when you're selling premium tends to be on those kinds of days, Friday, where the market just grinds higher. You never get a chance to really take off that premium to the upside. And it's also where I think a lot of investors get very frustrated with, selling covered calls, because they're selling them at very low volatility, and then the market is just ripping right through those covered calls. So anyway, so what do you do? Well, you look for the days where there's slight vol pops. You have to be very careful to the upside of how close those strikes are, and perhaps you are slightly more aggressive on the put side, on credit put spreads and things like that, and following that kind of trend. Back to the expected moves for the week, we're looking out to the end of the week, about 1%. That takes you up on the end of the week, almost to 5,200. And we are going to go out to those Friday levels. And you can see the 51.87 and the 50.77. If we took this and we made it a little wider, let's get that up to the 5,200 level on the upside. And just naturally, that takes you down to about 50.63 on the downside. And even you could even come down a little bit lower on that put side, give yourself a little bit of room. Here you are looking at about 150, risking 350 to make 150. You've given yourself up to 5,200 on the upside. You've given yourself down to about 50.50 on the downside.